The topic we're debating today is this. With the economy on the mend, it's time for more businesses to launch IPOs. I will be presenting the con side of the argument today. While for some companies, such as the Agricultural Bank of China, who raised $19.2 billion in the first day of their economic initial public offering, find great success in using their processes, IPOs are far from a guarantee of success. There are 5 reasons specifically why an IPO may not be the best funding decision for many businesses these days. I will be quoting data from a PricewaterhouseCoopers LLP study that details the regional costs of funding via an IPO. First cost, the cost of doing an initial public offering can be extremely inhibitive. Every IPO requires SEC filings and legal fees, which, depending on the amount of funding a company wants to raise, can be inhibitive in comparison to the cost. 48% of CFOs who were involved in an IPO said that the cost of the IPO exceeded their initial expectations. The average cost that is attributed to an IPO is $3.7 million, which for many smaller firms is no small amount. Secondly, is the amount of scrutiny that comes from being a publicly traded company. The accounting standards for a publicly traded company are much more stringent than one that is privately held. Companies are now held to strict timelines in regards to when a financial reporting is due, and the audits which are conducted become much more stringent. Thirdly, the cost of being a publicly traded company add a significant overhead to the company's everyday operating expenses. Now, there are auditing and accounting teams that are hired on the company's books in order to meet GAAP standards. Resources are now diverted away from the core competencies of the business and put into paperwork and accounting aspect of the business. Fourthly, becoming a publicly traded company shifts a company's focus from that of a long-term mission to one that is driven by quarter-to-quarter profits. The company's focus no longer becomes do what is necessary to build a substantial yet solid base for a company that is driven by the mission of the founders to what types of earnings are we going to report for the shareholders. In the article, John Bantelman discusses the potential shift of how management spends their time from being involved in the day-to-day operations to being dedicated to investor and board relations. The difference is that CEOs are showing that they spend about 20% of their time dedicated to investor and board relations. Last of all, IPOs do fail. Let's take a look at a recent example which garnered huge amounts of publicity. Facebook had a market capitalization of $104 billion at the time it launched its IPO, with initial shares being sold at $38. While there were significant faults in this valuation, primarily overvaluing a business that had very little revenue, many believed that Facebook would be revolutionary with its IPO. In reality, this was the complete opposite of what happened. Within 9 days of their IPO, Facebook stock had dropped 27% of its total value, and to this day, many months later, Facebook is still valued at the same level of 26.52. Facebook is just one example of how sensitive and challenging an IPO offering can be, as well as costly. In conclusion, while IPOs may be the right path for some companies to pursue, there are many other options that might make sense for smaller companies who don't need the huge billion-dollar valuations, such as Facebook. Options such as angel investors provide the company more flexibility in how they run their company. One can point to successes in both standpoints, but in this current state of economy, with it being a borrower's market, investors are looking for ways to increase investments, which is done more effectively through private investors and not necessarily through an IPO. Companies such as Zappos have shown that you can have angel investors and halo investors and still be bought out by larger companies down the road. While not every single company's goal is to be bought out down the road, it does provide a little bit more flexibility and more funding in order to run the company how you choose to run the company.